Hello my fellow investors and welcome back to another video. Guys, I am finally back from vacation. This is not actually pre-recorded. I am actually here and well, seeing that I've only given you guys pre-recorded stuff with TD and Dell, which by the way guys, the market on Friday was crazy. I was watching that from my parents' house. It was absolutely insane. It sucks I wasn't here when that was happening. I would have been throwing a party. But nonetheless guys, I do actually want to bring all of you guys a video today, and not just something that has to do with like stock analysis. No, I actually want to do something a little bit more in depth, and actually something that has to do with a question that I asked in my community post a couple weeks ago, I believe. If not a couple weeks ago, then a couple days ago. So I would actually like to go over that today, and essentially what I would like to use with that in the future. So with that said guys, let's get started with this video. Now guys, a couple days ago, I actually put out a community question saying thoughts on options, where the three choices were they are great, don't really know much about them, and no way they are way too risky. A majority of you guys said, 68% said don't really know much about it, 21% said they are great, and 12% said no way they are too risky. So I would actually like to go over this because, well, if you guys have seen my videos before, especially my first investment portfolio video, yeah, you guys know that I have had quite a thing with options in the past. However, guys, well, I think that I'm fairly, I don't know, a much better investor now than when I was 21. I'm definitely more risk averse, if that means anything, right? And well, seeing that a lot of you guys don't know, I would actually like to talk about exactly what options are. And it's a little bit tricky, so I'm actually going to pull up Investopedia to give all of you an exact definition. What is an option? The term option refers to a financial instrument that is based on the value of an underlying security, such as a stock. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. Each option contract will have a specific expiration date by which the holder must exercise their option. The stated price on an option is known as a strike price. Options are typically bought or sold through online or retail broker. So guys, essentially what an option is, you are writing a contract or you're accepting a contract from somebody else, which you are saying, okay, I believe that this stock price will be at this point at this certain date, and if it happens, then great, and if it doesn't, then you lose. Now there's actually two different types of options, call options and put options. The one that I've actually had a lot of problems before in the past, guys, is buying call options. Now I'm not going to do that ever again because I lost a whole lot of money and it's just way too risky. Buying call options is essentially saying, I think that this thing will go up to this point by this certain date, and if it does, then great. I don't even know what happens after that, honestly. Like, my knowledge on options, or at least when buying call options, is that limited. Aside from that, I have no idea, because the first time I ever bought an options contract, it was so out of the money that I was saying, I believe the contract was the Dow should have gone to a specific amount, and it was, unfortunately, the markets were just crashing day after day after day, and it got to the point where it never reached that, and the contract expired, and I was down like $1,000 or something like that. It was crazy. So yeah, when it comes to, you know, buying call options or buying put options or whatever, it really has left a really bad taste in my mouth. So now you're probably wondering, well, what's making you do this again? Like, didn't you learn your lesson the first time? Well, I did, and the reason why I'm actually going to do this again is because I am not going to buy call options or even put options. What I am actually going to do, guys, is something called selling cash secured puts. Now, let's actually take a look at what that actually means. Coming back to Investopedia, we got how to sell put options to benefit in any market. Selling, also called writing a put option, allows an investor to potentially own the underlying security at both a future date and a more favorable price. In other words, the sale of put options allows market players to gain bullish exposure with the added benefit of potentially owning the underlying security at both a future date and a price below the current market price. So guys, this is the one thing that I'm actually looking at right now, and I've actually been doing a whole lot of research when it comes to this. I'm gonna give you guys what this actually does. I'm gonna give you guys some examples as well, and I'm gonna give you the one risk that I have found when it comes to selling put options. And to be fair, that risk, at least for me, pretty much is underweighted as to all the other benefits that you get. And on top of that, I am going to show all of you guys exactly how this could actually benefit the dividend passive income, as well as how you can incorporate that using all of my calculators that determine a stock price, because all of these three things actually fit in perfectly with each other. So seeing that I have found this brand new thing, I know, by the way, this is no way brand new, but you know what? It's new to me, so I'm calling it brand new. Because I've recently just found out this brand new thing for me, guys, I would like to share it with all of you guys, because if anybody is willing to try this, I'm not willing to try this yet, because again, I'm trying to save up for a house at the moment, but nonetheless, if in the future I do end up investing again, I'm going to 100% do this, and I'm going to give you guys exactly the benefits of selling put options, as well as the opposite of that, but I'm not really inclined to do that. So let's actually start off, guys, with an example of what this thing actually entails. So we're going to be using, guys, Apple as an example, and then I'm going to use another example as well. But just to simplify what Investopedia was saying, guys, essentially a cash secured put, it is pretty much you are writing a contract and you are saying, okay, I want to buy this company. I am going to give somebody the right to allow me to buy a company of my choosing at a lower price that I would personally like. In this case, we'll be using Apple. And if the price does fall to this point that I am saying by the assorted time, I am forced to buy 100 shares of that company. If not, then I don't really get to buy it. And on top of that, as soon as you write that contract, you are automatically paid a premium for that contract. So let's actually use Apple here as an example. Guys, Apple's current share price as of Friday, I'm going to be using Friday's share price after market. It is $162.45. Obviously, everybody that knows me, I want to buy stuff that's cheap, right? I want to buy really cheap companies like Apple, but that are like really cheap. So if I were to sell a cash secured put on Apple at a certain price below this 163, I would actually need to have that cash on hand, or at least either have it on hand or have it through a margin account in order for me to buy the 100 shares if the stock price does fall to the price tag that I am saying. So again, Apple's share price as of Friday afternoon, guys, it was $162.45. So let us actually come over here now to Webull. Now, I'm not going to be using Webull when I do this, or if I do this in the future, but I just figured, you know what, I've been using Webull a whole lot. Let's just keep using Webull, why not? So here I have the options contracts, the put options contracts for the stock of Apple. And here we have a lot of options, guys, right? We have $70, $75. We also have the dates up here, but I would like to do this at a future date. So, but let's just say by October 21st, 2022. And if we actually go back to my past videos when it comes to Apple, you guys could see that I already done some kind of analysis on this. And well, my target share prices are essentially between $125 to $150 for the median and high assumption. So let's actually come back over here to Webull, and let's actually look for this strike price at around like $130 or so on October 21st of 2022. So as you can see right here, we have $130 when it comes to Apple at a bid of 75 cents and an ask of 79 cents. So let's just pretend that we are going to write this contract. This is the one that we essentially want to sell to somebody else, to essentially give them the right to force us to buy 100 shares of Apple at this $130 price tag on October 21st, 2022. Obviously, I'm not going to do this here on Webull because I don't have the money for it, but I did, guys, set up a Google spreadsheet on this to essentially just paper trade it, I guess you could say. So I have here the ticker symbol of Apple, share price, which we just saw at $163. Google Finance takes it from 4 p.m. on Friday, so it doesn't take it post-market. So let's just take it $163. We are going to put right here today's date, which is August 28th, and we're going to close it, guys, on October 21st, just like we saw over there. That's like around 60 days or so. The action would be a cash secured put and a strike price of $130. Now, the bid and ask are different, right? The bid and ask were, if we remember over here, for Apple, it is 75 cents and 79 cents. So let's actually put this over here at 75 cents. And then for the ask, it was 79 cents. And now usually what I find from this is that the premium that you get, guys, it is essentially between, or the median between, the bid and the ask. So you're probably saying, where's the $77 coming from? Because each contract is per 100 shares. The median between these two, it is 77 cents times 100, it is $77. So if you were to actually write this contract, we will get a premium. Again, correct me if I'm wrong. I have never done this before. I've never even wrote a single contract before. I'm going this from just all the videos I have seen on YouTube and all the research I've done on Google. Again, the premium, from what I've been seeing, is between the bid and the ask. So in this case, it will be 77 cents times 100, it'll be $77. As soon as you write this contract, you would actually get paid in cash. It will get deposited onto your account, into your brokerage account, $77, boom, right there, just for writing the contract and somebody accepting it. Now, the caveat to this is that, again, this is a cash secured put. So once you write that contract and you send it off and somebody pays you this premium of $77 for you to buy those 100 shares from them at a target share price of $130, right, by October 21st, you guys need the money on hand in order to buy those 100 shares. And that actually is this total cost. You would essentially need, guys, $13,000 to buy 100 shares of Apple at $130. So right then and there, you're probably saying that's a whole lot of money. Yeah, but you're also getting 100 shares of Apple, right, at a really, really low price. And then usually when it comes to writing contracts, there's usually a fee. I have never seen it because, again, I've never written one, but I just said, you know what, 10 cents. And it's not 10 cents per share, it's just 10 cents for the entire contract. So after all this, guys, with the premium being paid to you as soon as this is written, you would actually get paid a total profit of $76.90 just for writing this contract. So it's essentially 77 minus 10 cents, $76.90. That's not too shabby in my personal opinion. So what happens once this is actually created? Well, now just wait. Essentially, now what you do is just you wait up until this closing date comes of October 21st. So if the closing date comes, let's just skip forward 2 months, and the closing date comes and Apple's share price, it is still above that $130 mark, well, the contract expires and you don't get to buy the 100 shares, right? You don't get to buy the 100 shares. However, you keep this premium. You actually keep this premium of $77. So it's a win-win no matter what you do, right? Because if you're doing stock analysis, which I do all the time, and you're saying, I'm not going to buy this thing until it gets to this specific price tag. Well, if you were going to buy it regardless at $130, right? Why not just sell the contract, have somebody pay you to essentially be forced to buy it at the price tag that you already wanted. If it reaches the strike price by October 21st, then congratulations, you get your 100 shares that you wanted, plus you get to keep the premium. And if it doesn't, then you get to keep the premium, and it doesn't matter if you don't get the 100 shares because it didn't even get to the price tag that you wanted anyway, so it doesn't really matter. All in all, it is pretty much a good thing for you in general. Now, let's add on top of this, guys, the dividends that you get from this, because remember, you are purchasing. So now let's actually say that the share price of Apple in this case does fall, let's just say, to $130 by October 21st. Well, now you are forced to buy those 100 shares. By the way, I'm not really sure if you're forced or obligated. One of those two that I don't think you're forced to, but I mean, you should still be willing to buy those 100 shares at the current share price based off of the contract, right? Because, I mean, you want the shares regardless. So let's just say that in this case, by October 21st, the share price of Apple does reach $130 and your contract does get executed. Well, at that point, you would have to buy 100 shares of Apple at $130, which would be $13,000. So let's actually now come over here to the dividends holding, and let's actually see how much in dividends you would get from Apple by having those 100 shares. So here I have Apple. I actually do own Apple, guys. Believe it or not, I actually do own Apple. I don't know, I own very, very tiny, but nonetheless, I do own Apple. So let's just say that, okay, the contract got executed. You have to buy the 100 shares. how much in dividends would you get for buying these 100 shares? Well, I actually have the calculator already kind of set up. So we do 100 times the current share price of Apple, which obviously if this would be at 130, you would only pay 13,000. But just to get the 100 shares over here, let's see how much in dividends you would get. Essentially, guys, you would get $23 in dividends for Apple if you were to be forced to buy these 100 shares at, again, 13,000. I know here it says 16,362, but I'm giving the hypothetical example that over here you would do 13,000, right? Because in this case, the strike price is $130. So yeah, you would get an extra increase, guys, in your dividends of $23 overall when it comes to Apple. Now you're probably saying, $13,000 for $23, that is ridiculous. Well, sure, you might consider that ridiculous, but I have two things to tell you. Number one, that's $23 extra in income every single quarter that you are getting. That's not too shabby, guys, right? Imagine getting extra $23 increase per quarter just by not doing anything. That is amazing. And on top of that, guys, remember, you just bought 100 shares of the company Apple. Apple, the biggest company in the planet. Yeah, that's not too shabby in my personal opinion. At a discount nonetheless, right? At a discount, which is just amazing to think about. But okay, I fully understand. You know, you may be not interested because it's $23. Okay, let's actually do now, guys, one that a lot of people know and a lot of people like. Let's actually do an example now on the company Realty Income. And for all of those of you who may not know what Realty Income is, guys, well, Realty Income, it is a really, really notable one when it comes to the dividend space. It is a real estate company that, well, pays a very good dividend monthly, which is amazing. They've grown it for 25 consecutive years. The current yield today, guys, at $69.91. It is 4.25%. They pay out 25 cents per share. And of course, this is monthly, guys. And annually, they pay out $2.97. So let's actually see what kind of price we would get if we were to take this company and write a cash secured put into getting 100 shares, assuming that the price tag actually fell to the target share price that we would like. So let us come back over here, guys, to Webull and see the kinds of contracts that we could essentially write to have a cash secured put into Realty Income. And let's say that, again, the current share price is $69.91. Let's say that we would like to buy this at like $60. So we have this contract right here at $60. We can see that the bid is 15 cents and the ask is 35 cents. So if we come back to over here to the spreadsheet, let's actually input the ticker symbol together. We can see the share price right there. Let us say the exact same day as today, or actually let's just say this tomorrow. And for the closing date, we're going to put the exact same closing date as before, October 21st. That would essentially be, again, 53 days. It'll be a cash secured put, guys, and the strike price, it will be $60. And if we remember the bid and ask, the bid was 15 cents and the ask was 35 cents. So let us actually come over here and put 15 cents and the ask was 35 cents. Now the premium for this would be the between price between the bid and the ask, which in this case would be 25 cents times 100, because each contract is 100 shares. You will get paid $25 for writing this contract. Now you're saying that's a lot less than Apple at 77. Okay, but here's the fun part when it comes to this. You only need, guys, $6,000 to make sure that you have in your account in order to buy the 100 shares, assuming that the share price actually falls to the $60 strike price that you said before. And then let's just do the exact same thing. I don't know, 10 cents. Their total profits for writing this contract would be $24.90. So, okay, time passes, the stock price doesn't fall to the $60 mark. Congratulations, you keep your $25, and which ends up being $24.90 for the total profits. Awesome. But let's just say that the stock price does fall to $60 by October 21st. Well, now you have to buy 100 shares of Realty Income. So let us come back over here and let's figure out how much in dividends, guys, you will get from buying 100 shares of Realty Income. So we're going to do the exact same thing. We're going to do 100 times the current share price, just because we need it to be the current share price so that way we can see how much 100 shares would be. And if we actually come over here to find it, we can see that, guys, this would be a dividend difference of $24.75. So essentially almost $25. Guys, that is per month. Okay, that would be a total projected dividends, at least for me, total projected dividends of $31.82 per month. That is not per quarter, that is per month. So if we actually extrapolate this $24.75 to the year, we over here do this times essentially 12, guys, that is an extra $297 on the dot. Think about that, guys. Think about increasing your yearly income by $297, essentially $300, right? And on top of that, you bought it at the price tag that you wanted to buy it at, and you also got a premium of $24.90, of course, after the fees. Guys, that is absolutely amazing. So this is kind of what I'm talking about, that at least for me, this is new. I have never done cash secured puts before, and I personally like it. If this thing can actually really accelerate your dividend income, just because of the fact that if you're gonna buy it at the price tag that you wanted to buy it in anyways, you may as well just get a premium for it. Now, what are the downsides when it comes to this? Because all I've talked about is just goodness all around, right? And by the way, if I'm missing anything, maybe some of you guys know a lot more about this. Again, I'm a noob when it comes to this. I would like to eventually do it and learn as I go. And by the way, I would like to make videos on this of like writing options contracts, you know, cash secured put contracts, like live for you guys, I guess you could say. I would actually like to make that kind of content. I think it's very sparse throughout YouTube. But yeah, nonetheless, guys, what are the, I guess, bad stuff or the risks that comes from when it comes to this? Because, well, it doesn't seem to be any risks. Well, from what I've found, and again, tell me if I'm wrong, from what I've found, there's only one risk. And that is that, for example, let's just go back to over here, the Apple example. If Apple falls, if you want to buy an Apple at $130 by October 21st. So if by October 21st it reaches, or if before October 21st it reaches $130, great. Now, if the price tag continues to fall below this $130, and it hasn't, and it's not even October 21st yet, and by the time October 21st comes and the price tag is, let's just say, $110, well, unfortunately, you are now forced to buy these 100 shares of Apple at 130, even though the price tag, it is lower than 130. That, I think, is the biggest risk when it comes to this. That in that case, you would essentially be losing around $20 for this example, because the share price then would be 110. The strike price is 130, and you are forced to buy it at 130. Now, there are things you can do to essentially like close out the contract and all this stuff and still keep the premium and all that stuff, and you could just rewrite it again. But I don't necessarily know too much about that part. So from what I'm looking at this is that would be the only risk to essentially selling cash secured puts. So all in all, guys, the way that I see this is like very, I guess, risk free. There really isn't any risk at all. You have the potential of buying the company that you want at the share price that you want, which again fits perfectly with the calculators I have available for all of you guys. Again, please have them. It really does help. If you do eventually end up buying it at the share price that you want, that will increase your dividend income, which if you're a dividend investor like me, that helps you out a lot. And on top of that, regardless of whether it falls to the price tag that you want or not, you are keeping that premium. So even though you do have a risk that if the stock price falls more by that closeout date, I guess you would have to buy it at that higher price. That, to me, that kind of risk is significantly lower than all the other benefits that you get from it. Now, there is something else that you could do, and that is something called covered calls, which is essentially the opposite of this. It is basically you guys already owning 100 shares of the company, and then you are giving somebody else the option to buy those 100 shares off of you, assuming that they reach a target price in the future that's higher than the current one that it is today. And on top of that, you also get a premium, you do all that stuff. If it reaches that target share price that's higher than what it is today by the closeout date, then you have to sell those shares. but if it doesn't, then you get to keep those shares. I personally think that that one is good too, don't get me wrong, but from a dividend perspective, I would rather just buy and hold, right? If my strategy is buy and hold, why would I sell, companies like Apple or companies like Realty Income or Home Depot that pay out a massive dividend? Why would I want to risk having to lose 100 shares of them? I don't want to do that. I want to accumulate and hold and grow that dividend. So for now, I'm going to stick with cash secured puts. We'll see what happens in the future. And I'm saying that like I'm actually even doing these cash secured puts. I'm not yet anyways. But I personally think that cash secured puts, from my personal opinion and from my situation, it is significantly better. So all in all, guys, that's essentially my plan when it comes to this in the future. Now, I have M1 Finance. If I do end up doing this, guys, I probably will leave M1 Finance and I will probably go to like a major brokerage. I'm thinking about Charles Schwab, but again, we'll come to that when we come to that. And if I do end up doing that, guys, get ready for a lot of like, watch me sell a cash secured put for Apple at whatever price tag I choose to, because I really would like to make those kinds of videos. They sound really interesting. But nonetheless, guys, that pretty much is it for this video. Like if you like, comment, subscribe. But always remember, this is not financial advice. None of this was. I'm showing you guys what I plan to do. If you guys want to do it, go ahead, but do it. I am not an expert in any of these options contracts. I lost a ton of money, okay? I lost a whole ton of money buying calls back when I was 21. I'm redoing this again just to see what happens, and I think this time I'll get it. This doesn't mean that you guys should do it. Please do your own due diligence when it comes to this. This is just what I've figured out so far. If some of you guys know what other risks you may have or other stuff I missed, please leave it down in the comment section below. I really appreciate it. But again, not financial advice, guys. And when it comes to whatever company you may want to buy, please have the calculators for free. Again, in my calculators playlist, there's a video that consolidates all of them. See what kind of price you would like to buy at them at. So that pretty much does it. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. So with that said, guys, peace out, and I will see you all in the next video.